Congressman Luetkemeyer, thank you so much for your time. You are running to be the chair of the Financial Services Committee should Republicans keep control of the House. What does a Luetkemeyer chairmanship look like? What are some issues that we can expect you'll focus on early on?
Well, I think, to me, the importance of the Financial Services Committee should be focused around protecting and promoting economic freedom. Economic freedom in this country is so important from the standpoint of being able to drive our economy and enable the entrepreneurs of our economy, of this country, to drive the economy. I have the opportunity to sit in this office and every day see people from around the world come through here, and they are so envious of our system, of our ability to have entrepreneurs to drive our economy, to be able to go out and start a business if you want to today, or if you want to get a different job, go get a different job tomorrow. Whatever you want to do, you can do, because you have the economic freedom to do that. And to me, what we need to be doing in this committee, and we have been doing a good job of it, but I think we need to continue to do this, and is focus on economic freedom, to make sure people have the ability to reach their heights of their desires to be able to participate in whatever the economy can be beneficial to them for.
Okay. So how are you going to do that? What are some areas where you and Democrats agree? What can we expect to see early on in terms of issues that you...
Well, there's a number of perfunctory things that we have to do with the committee. In other words, there's certain things that we have to, every so often reauthorize, like flood insurance, terrorism insurance, and things like that. But I think if you go through what I've done and have been able to work with members across the aisle, and if we have narrow margins, we're going to have to be able to do that probably even more. To be able to bring them in and say, hey, look, how can we work together to find ways to move our economy forward, to continue to protect the access to credit that people need to go buy houses, to start businesses, and find ways to reduce the cost, to allow lenders, the people in the financial services industry, to be able to provide those services. We're in the midst of a fintech revolution right now, at the very beginning of it. Who knows where it's going to go to? So I think over the next several years, we're going to have to watch that the industry itself grow and how it's going to impact the financial services industry. Does it impact it in a very positive fashion, a negative fashion? Are we doing things to help it, to hinder it? What are we doing? So I think as you go through the process here over the next several years, I think that, again, we have to be sensitive to what it takes for individuals as well as businesses to be able to be successful in their own financial worlds, their own financial lives, and enable the financial services industry to provide those services at a cost that the public can afford. And so what do you say, what do you mean by cost? Well, give you an example of Dodd-Frank. Initially, there was 75% of the people were able to have free checking. Now it's down to 37%, cut in half. I think we need to be able to have home loans that doesn't take a stack of papers that thick to be able to work through, as well as the cost to do all that. We're losing one community bank a day, one credit union a day combined. And it's not because they're being mismanaged. It's because of the compliance costs that are out there. So I think these are all things that we have to look at. We have to watch. We have to be careful of. Do we really need a stack of papers that thick to be able to make a home mortgage loan? I can give you, with more time, I can give you an example of why we shouldn't do that. But, I think there's just a lot of work to continue to do. I think we have to work with the regulators. They have a job to do to be able to enforce the rules and laws. But what we've seen with the past administration is they've issued guidance, and suddenly that became the rule, in essence, law. And so we have to find a way to stop that nonsense so that the regulators get back in line of doing their job, of regulating, and let the financial institutions and industry do what they do best, which is serve the customers.
Can we talk a little bit about the race for the committee chair? Fundraising has always been a key prerequisite to be on this committee historically for both Democrats and Republicans. Not surprisingly, it's the finance industry where a lot of those fundraising dollars come from. So from your perspective, what role does the finance industry play in determining who's going to be the next chair of this committee?
Well, I don't think that the industry determines the next chairman. I think all of the people you mentioned a while ago are great individuals. And I think when the steering committee sits down, yes, they look at the boxes that you're checking. One of them is, are you meeting your dues to be able to, your assessment to be able to help the team? So I don't think that when you get to the steering committee, that's one box that needs to be checked, but there's a whole lot of other boxes that need to be checked. So the financial service industry is you'd be surprised, some of the players in the industry are not flush with cash. They're small associations that represent niche industries within the industry. And so people think that this is a very flush industry and that it's got lots of money. Well, there are certain groups that do, but there's a lot that don't. So again, that's not why we're here. That's not why we do what we do, but it is a part of trying to check a box to be able to get the steering committee to consider what's going on.
Do you check that box?
I sure do.
Okay. If you look so far this year, you've raised about $1.9 million. It's from across the majority of your contributors are in the financial space. Big banks like Goldman Sachs, trade groups, American Banking Association, independent community bankers, life insurers, credit card companies, so a broad range. How would you show, how does that differentiate you from your peers in terms of checking that box on fundraising?
Well, I don't know that it would. I'm sure that they're doing the same thing, that they're being supported by the industry for the work that we've been doing. For somebody who's capable of carrying bills, somebody who's willing to do the work on the committee, to be able to work an issue through the committee, work it through the House, try and get sponsorship in the Senate. If you're able to do that, people support you to try and make sure that you stay around because you're somebody that can get the work done. If you sit on Energy and Commerce, you sit on Ways and Means, you'll see a different portfolio of people who support, or industries that support those folks because they oversee those issues. So I don't think it's unusual for somebody sitting in financial services to be being supported by financial services folks. And I think if you look at the other side of the aisle, you'll see that they get some support as well.
Sure. One more question on fundraising. Mick Mulvaney recently described a hierarchy that he had in his office when he was here in Congress and on the Financial Services Committee, where constituents from his state as well as lobbyists who gave him money came at the top. Do you agree with this approach, and what is the hierarchy in your office?
No, I do not have a hierarchy. My hierarchy is this. Anytime there is a constituent in my office, I want to try and meet them because I feel if they've taken the time to come to Washington, I should take the time to see them. And we make every effort we can unless we're stuck in a committee somewhere or we're stuck on the floor voting. When it comes to the lobbying corps here in D.C., I can't physically meet with everybody. I do what I can. Again, we have great staff. They meet with them. But if the question you're asking is, does the money play a difference in who we see or we don't see? No, because I don't have any control over the books of my campaign. I don't know who's giving me money, who's not. I don't know who gave me a check yesterday and who didn't give me a check yesterday. So, and I don't want to know. I know that we're raising money and that we seem to be doing well. We have fundraising events where people attend, but I don't know whether they give me a check for $1 or is it for $1,000. And I don't want to know because I want to be able to talk with you if you're representing a certain group of people, and be able to understand your issues and work as hard for them as I do somebody down the road here who may be a bigger supporter. So to me, it doesn't make any difference. I've been around this business for 20 plus years. It's hard to influence somebody with a $1,000 check when it takes $2 million to run a race.
You mentioned fintech earlier. Cryptocurrencies. Do you own any?
I do not.
Why not? What do you make of this growing market?
I'm a very conservative guy, and to me, this is Russian roulette with two guns. It is a very, very volatile situation right now with cryptocurrencies. I don't know that we have a handle on it either with the regulators that are regulating it or whether even the people who are in the industry quite have got a handle on it yet. I know that there's some illicit financing going on, and they run because we're trying to, things that are being done by our Treasury folks and folks trying to find them, our law enforcement folks trying to track them down. They've kind of turned to that perhaps as a way to do to launder some of their money. So we've got to watch it. We have to be careful with it. I personally think until it's at a point where it's much more accepted and there's less volatility in the market, I think you can really, really get hurt.
Should the SEC have more authority?
With regards to cryptocurrencies?
Right.
I think so. I don't know that they don't have enough right now. That'd be a good question to ask Jay Clayton if he really needs more authority, needs more flexibility to be able to oversee that. I couldn't give you a good yes or no answer on that because I want to talk to him to see what his feelings are, and if he needs more or needs something else, I think we should be willing to work with him and try and give it to him. If they have plenty of authority now and I know he's a little reluctant to get involved in it right now to a much greater extent than what he already is. So I'm not sure that, until he's willing to, or something happens that he feels that they need to address with more laws, and he doesn't have the authority to do what he needs to do to protect the consumer, then perhaps we need to step in. But until then, I'm okay with whatever he's okay with, because he's in charge of it. I'm not an expert on cryptocurrency. So that's why I defer to him. I'm not an expert on that.
Housing reform.
Yes.
How much of a priority is fixing the GSEs in the next Congress for you?
Well, I think it's going to be a priority of the administration. And I think if it's a priority of the administration, it needs to be a priority of the committee. So that will be one of the priorities that we will have.
What is your reaction to the White House report that came out last week? Do you agree with that approach?
Well, yeah, it's been discussed. I think at this point we need a little more detail in it. It's not much different than some of the other ideas that have been thrown out there. But quite frankly, and I've said this for a long time, I don't think we're going to get anywhere on housing reform unless the administration takes the lead. This is a really thorny issue.
And we have.
Yeah, they need to take the lead. The administration needs to take the lead, period. They need to set down a structure on how they want this to fall out, and we can fill in the blanks on it. But they're going to have to give us, in my estimation, similar to what they did with tax reform. This is our goal. This is how we'd like to see you get there. But at the end of the day, we have a goal from them, and we will fill in the blanks on how you get there. And then I think if we approach it from that angle with them leading the way, I think we'll be successful. But for us to come up with an idea that is contrary to what they would like to see is, quite frankly, wasting our time. I think you've seen some issues that have fallen apart because of that.
But haven't they? With this report last week, they did outline they're putting it in Congress's hands.
Well, they've come out with some ideas. I'd like to see the Treasury Secretary endorse that plan.
Okay. Well, that was going to be my next question. Is it your understanding that it's your understanding that he does not endorse that plan?
My understanding was there's still some discussion within the administration with regards to how that plan's going to play out.
Okay. Where do you foresee being some of the, thorniest issues?
Well, I think you start with, how do you wind down Freddie and Fannie? Do you wind them down? And do you go to a private sector scenario? Do you take them and privatize them, which is kind of what they want to do? Or do you leave them set and just let them keep doing what they're doing? If so, if you go to the private sector over here, the first scenario, what do you do with FHA? Do they become your de facto government guarantee agency? Will there be a de facto government guarantee agency? So those are all things to me that need to be sorted through here. Which scenario do you want? Do you want a private sector solution with a government guarantee, which is what most people kind of migrate to, something along those lines? And if so, how do you want that to play out? Do you want Freddie and Fannie to just sort of transition over here, or do you want to start out, wind them completely down, or start with a new entity, whatever it would be, that would be a secondary mortgage market purchaser and bundler?
So if you are expecting that the Treasury will fill in some of these blanks, why did the White House come out with that report if it didn't have input from the Treasury? Well,
it did have some input from the Treasury. I don't think there's unanimity among the folks in the White House yet on how this is going to play out. That's my point. And I think I would like to see a little more detail on it. I think we need to get some more feedback from them and a little more leadership, quite frankly. So we're going to have some hearings this fall. I sit on a Housing and Insurance Subcommittee. I know Chairman Duffy is intent on trying to do this. I know Chairman Henschling is wanting him to have some additional hearings, and I'm sure he will. So we'll get some more info, and hopefully there'll be some more leadership from the White House to be able to sort of point us in the right direction, how they'd like to see this all play out.
Senate Majority Leader McConnell has said that he will hold a vote later this year on another set of financial reform package, this time focused on capital formation. At this point, what do you expect will be included in that, and when do you expect the House will move?
Well, Chairman Henschling has come up with I think a list of about 25 bills right now that he's shopping around and discussing with the Senate Democrats and Republicans to see if there's some interest in trying to do an additional package. He's working with Senator Crapo and Senator Brown and trying to get them to work through some of these bills and see if there's some common interest there on some of these bills. I think if we could get a package put together, I think we'd like to probably see if we could get a vote on the floor before 1st of August to give the Senate some time, perhaps over our August recess, and they're going to be in for much of it, as well as any time this fall that they could find time to. Senator McConnell has, as you said, promised a vote on it. So we've got some floor time in the Senate. We just need to figure out if we can put a package together that can attract enough Democrats to it that would get to the 60. And we've and talking with the senators as well as Chairman Hensling, we've told them, I said, if you don't like one of the bills of the 25, kick it out. If we get 20 out of the 25, that's fine. That's 20 bills that we passed that are going to make a difference for, as I said a while ago, to protect and promote economic freedom for our citizens and our financial institutions that weren't there. And so I think it's important that whatever we can get, we would take. At the end of the day, we understand that it's got to be non-controversial, and we intend to make it non-controversial, but there are a lot of bills that are non-controversial that they could take if they had the desire to, that would make a big difference in how financial services industry works.
So broadly, who will benefit from what the universe of bills that you're looking at now? What types of investors, what types of finance companies will benefit from this? Well,
Jeb has called it Jobs Act 3.0. So it's a lot more of the capital markets side, a lot more of helping businesses have access to capital, trimming some rules and regulations to allow the regulators to be a little more, a little less stringent on some of this oversight they're providing, and entice the financial community to get a little more involved in business lending. So I think most of it centers around trying to help the financial services community address the needs of the business community to be able to promote jobs and enlarge and get their businesses going, keep them going.
You mentioned Jobs Act 3.0 as this is being dubbed. What evidence is there that Jobs 1.0 has worked?
Well, I don't think there's a whole lot of evidence, if you can point to it, that it hasn't worked. And we continue to have a robust economy. You see the unemployment continues to go down. People are finding jobs that they couldn't before. There's training dollars out there now. The employers are looking for opportunities to actually train their employees. So I think the Jobs Act has been very successful in enticing the business community into participating at a higher level and enabling people to participate as well.
Sure, but if you take a look at, for example, making it easier for companies to go public, that is something that we are still hearing from Jay Clayton, for example, that is still a problem in the market. So if it didn't work back then, what about this time around makes it any different?
Well, there have been hiccups. There's no doubt. It's not every single issue has been solved. That's why we had Jobs Act 2.0, and that's why we need a Jobs Act 3.0. We need to continue to, find those places where we have dropped the ball or we haven't been able to help. Find the places where we have had some sort of inconsistency or some kind of consequence that we weren't aware of. You're always fixing what happens around here, as you well know. And so there's unintended consequences with some of these bills, and we need to go back and fix it, just like we did with Dodd-Frank. We fixed some unintended consequences, and so that's what part of this is all about as well.
Last question. Since the financial crisis, a lot of lending has moved, both commercial and consumer, has moved outside of the banking industry to the shadow bank. Regulators, including those appointed by President Trump, have recently particularly honed in on private equity firms where a lot of the riskiest loans are being made. Does this concern you?
Yeah, it does. I think because, and this is the de-risking problem is one that has sort of manifested itself in the last 2 or 3 years here to, I think, a very concerning position. Whenever you have Christine Lagarde, who chairs the International Monetary Fund, talking about de-risking as a problem worldwide, it's like, holy smokes, that's a wake-up call there, because they're usually behind the 8 ball instead of front of it. And so we are in a situation where, I tell people, I said, look, if you're if what's happening, we had a hearing yesterday on de-risking, and it's very concerning to me because what has happened over the last several years here is that the regulators have come in and been so hard and so punitive with the way they've enforced a lot of the rules, regulations, and guidance that the banks have just sort of backed away, and credit unions and a lot of other lending folks have backed away from making loans and doing all sorts of other sorts of financial activities, as yesterday's hearing would indicate, to the point where I tell people, I say, if you de-risk the bank completely, one of two things is happening, if not both. Number one, the community is not going to grow anymore because the bank's not taking risks on that community, not helping to lend money and take risks so the community can grow. Or you've shifted all the risk to the government because that's the next. By guaranteeing all these loans, you've shifted all the risk to the government, and that's the only ones who are making loans. Or you've shifted to the shadow banking group, which is what you just said. So none of that is good because the government is all the taxpayers are now on the hook for all of this stuff, and the shadow folks most of them are unregulated. So we've got a situation where we've got to be very careful here because if we don't, and this is why the regulators have to be very, and each one of them, the new regulators, the new folks in charge of the agencies are very concerned about this from the standpoint that they understand that they have actually shoved businesses out of the banks and into the shadow banking area, as well as out of this country, as yesterday's hearing would indicate. People going out of the country and, in fact, out of the continent to get funds. So this de-risking has really morphed into something that is, I think, to the detriment of our society and our economy. So we've got to be very careful with it.
So what's the solution? Does there need to be more regulation? Is this something that you'll focus on?
That's the problem, Elizabeth, is more regulation. We need a different structure on our regulation.
What does that look like?
We need regulators who regulate, adhere to the law and the rule, but don't, through guidance, intimidate the financial institutions into not taking care of business. They need to let them be the initial folks who discern whether there should be a risk taken or not on somebody. For the regulators to come in and make the decision on whether a bank should or should not make a loan, that's the wrong way to go. The bank knows their community and their customer better than the regulator. The regulator needs to come in after the fact and say, okay, you did a good job or not a good job. And the bank needs to be capitalized well enough to absorb whatever losses they take because of the risk that they took. But they're always in the best position to assess risk, not the government, not the regulators. And so, to me, the regulators need to get back into regulating, just providing advice and structure to the rules and regulations that are there, and let the banks go back, and credit unions and those who are lending money, go back to doing that, assessing risk and taking risks. That's what they've done for all these years. Look where our economy is today, the biggest and most robust economy in the world. Why do we want to temper that with continuing down this road of hampering our financial services industry from being able to do its job, which is assess risk, help its communities grow?
You recently told a group of financial services lawyers and lobbyists at the Exchequer Club that
Were you there?
I was there.
Well, good.
And you said that a Maxine Waters chairmanship would be the death knell to many of them. I assume you were joking, of course, but what should Wall Street and the finance industry fear about a Maxine Waters chairmanship?
Well, I think they should be concerned from the standpoint, if you see the way that she has comported herself and the issues that she has brought to the committee and the way she has asked questions about different issues, that she is going to be adversarial to, I think, the financial services industry and I think consumers and businesses because her way of going about doing business is similar to what we just had 8 years of, where we've had declining GDP. And if you go back and look at the Obama years, the last 3 years, you had less GDP growth every single year. Now, my old algebra teacher back in high school told me that was a negative trend line. You're going the wrong direction. Since President Trump's come to office, in fact, since the day he was elected almost, we've seen an increasing trend line going the other direction. And why? It's because people understand that rules and regulations have consequences. Rules and regulations are restrictive to their ability to do their job, to invest in their communities and be able to, quite frankly, spread out the costs of operating. So I'm fearful that and concerned that if we will lose the House and Ms. Waters would be the chairman, I think you would go back to the type of rules and regulations and go back to the way of administering those rules and regulations as have been over the previous 8 years. So I think that's harmful to our economy. I think it'd be harmful to the industry, and I think it's harmful to our communities.
What about the rhetoric that's used, the anti-Wall Street bashing big banks rhetoric?
Well, it's interesting that she bashes the Wall Street guys, and yet they're the ones who benefit from her programs and plans, which is kind of unusual, but that's kind of the way it works out for her. But that's just, that's Ms. Waters. You'll have to talk to her and see what she's really trying to accomplish there, but we'll see what happens.
That doesn't resonate with voters, you don't think?
Her rhetoric?
Yes, that sort of...
Well, I think that she has certainly caused a big stir in the public. And when you get chastised by the leader of the House and the leader of the Senate for what you've said, I think you've stepped over the line.